So as with other sorts of insurance contracts, the group insurance contract still does have the Insurance Act apply to concepts like beneficiary designations. So this means that we still have to get properly signed beneficiary designations. They have to be actually signed in the plan member's own signature. It has to be clear who we're naming as beneficiary. This is an important legal concept with respect to group insurance. It does get overlooked a fair bit. And one of the things that often goes wrong is you have a plan member who joins at a relatively young age, perhaps naming their naming their parents as beneficiaries, and then 3-4 years later that person gets married and neglects to change the beneficiary designation at that point. So as the agent taking care of a group, regardless of the size of that group, you should make sure that somebody has reviewed beneficiary designations periodically with the plan members. The employer then is responsible for a variety of features of the plan. They're responsible for correct data entry. It is possible for the employer to download that responsibility to an insurance agent. Typically, we call that a third-party administered plan or a TPA plan. The employer is also responsible for that communication with plan members. Again, an employer should be looking for an agent who's going to do an excellent job of that communication with the plan members. The employer also should be looking at premium payments. They have to make those premium payments on a timely manner. The failure to make premium payments can result in a contract lapsing, which can result in the employees going without coverage. The employer also, it's their own responsibility to take care of payroll deduction. So if the employees are paying for a portion of the plan, the employer is responsible for managing that. The insurer is not responsible for that. And anything that has to be T4'd, that is anytime we have to communicate tax consequences to the employees, that is also the employer's responsibility. The insurer may be able to provide advice on that front, but it really is the employer who is responsible for providing that tax information, for making sure that employees are aware of the right amount of tax to pay. Okay, it's not my intention to get too much down in the weeds here with respect to the tax consequences of a benefits plan, but we certainly do have to understand some elements of the taxation of group benefits. So first off, any amount paid by an employer with respect to group benefits will normally be tax deductible. It's hard to find exceptions to that rule, but if the employer is treating a group benefits plan as a proper benefit for their employees, then generally any amounts paid by that employer will be tax deductible. Now, when the employer pays for the employee's group life insurance policy, the employer is paying premiums on this portion of a group benefits plan, then that amount of premium is to be added to the employee's taxable income for the year. Failure to do so will simply result in the employee being reassessed later on for any premiums that were missed. So many benefits that are available are actually going to be tax-free to the employee even when the employer pays those premiums. Critical illness insurance, although there is the opportunity for some debate here, in general we treat critical illness as a tax-free benefit. Certainly health and dental insurance outside of Quebec, travel insurance, employee assistance plans, they're all lumped together and generally considered to be tax-free benefits when an employer is paying premiums on behalf of an employee. And it's that tax efficiency that really makes this better than having employees go out and acquire their own health insurance. Accidental death and dismemberment can be tax-free or taxable. Honestly, it's just not that big a deal. The amounts we're dealing with here are typically so small that we don't run a lot of risk either way. But provincial insurance acts could, at least in theory, lend to accidental death and dismemberment being defined as either an accident and sickness benefit, which would make it tax-free, or a life insurance benefit, which would make it taxable. Disability insurance is certainly the most complicated. Unfortunately, the rules here are not that clear. Now, it is certainly the case, we know this with certainty, if the employee pays for a disability contract as part of a group disability contract, then those premiums are not deductible for the employee, and if they become disabled, they will receive a tax-free benefit. Now, if the employer pays, this is where it gets complicated. There is an interpretation bulletin produced by Revenue Canada, IT 428. It's quite old. It dates back to 1976. And that interpretation bulletin creates some confusion because there are two alternate suggestions within that same IT. One suggestion that the employer cannot pass premiums on as a taxable benefit to the employee, and one suggestion that the employer can pass premiums on as a taxable benefit to the employee. It makes it quite confusing. We certainly do know that when the employer pays even for the tiniest portion of the group benefits plan, that we do end up with a taxable benefit to the employee somehow. The question becomes, can we tax the employee at the time when they receive their disability benefit, or are we going to pass on a taxable benefit that is T for the employer for the amount of premium paid? If you wanted to take a risk-free approach to this, then you would not allow the employer to T for the employee for the amount of premium paid. If you're willing to take some risk with it, then you might allow the employer to pay the premium and pass a T4 on to the employee. You may not have any say in it. It may be purely the employer's accountant who makes the determination. My suggestion in general is that if you can get the employee paying for that portion of the plan, it's so much cleaner. Have the employer pay for everything else. So using some dollar figures here, we can see the tax efficiency of this group health and dental plan. So let's say we have Elaine, makes $60,000 a year. She's taxed at a rate of 35%. Her marginal tax rate is 35%. In her province, she happens to get tax credits at a rate of 24%. This would be about comparable to tax rates in Ontario. Not quite perfect, but close enough. And her employer, a small business, has a tax rate of 15% on active income. So, Elaine and her family, they incur a total of $2,000 in medical expenses. So Elaine's spending then this $2,000 a year in medical treatments. Let's say she has no benefits plan in place. So she would start to qualify for the medical expense tax credit once she spends more than 3% of her income. That's the case for most taxpayers. If you make more than $70,000, then you hit a cap. The actual cap for the medical expense tax credit is at $2,050 approximately. That is, nobody has a higher limit than $2,050 to begin qualifying for that medical expense tax credit. So she would have $200 in qualifying expenses, giving her a total tax credit, assuming a lowest marginal tax rate of $48, meaning her net cost is $1,952. In order to actually pay $1,952 at a 35% tax rate, her employer would really have to write her a check for $3,003. With the same $2,000 of medical expenses, let's say that Elaine does have a benefits plan in place. Well, really what's going to happen here, we're not going to get involved with that medical expense tax credit. Instead, the employer pays a premium for their coverage of, let's say, $2,800. That assumes about a 70% target loss ratio, which would be about average for the group insurance business. So the employer pays $2,800 of premium for Elaine to get $2,000 of coverage. That's $200 cheaper for the employer than having to write her a check for $3,000 to get the same amount of benefit. Now keep in mind both of those costs, the cost of the benefit and the cost of salary, would be tax deductible to the employer, so really it's an apples to apples comparison in that sense. So we can see then it's about $200 cheaper in this case, which I think is a fairly representative case for the employer to put in place group benefits as opposed to having no benefits at all. And that's just the strict tax calculation. That doesn't take into account the risk management aspect of it or the budgeting aspect of it. Really, this plan should make Elaine's life easier in a number of ways that are probably more valuable to her than $200 a year.